Hi, this is Linda Hitt. We're going to talk about another type of long-term debt, which we can call installment loans. And in this case, you actually repay the principal and you deal with interest on a regular basis, which is with each payment. Characteristics of this type of a loan. Normally you would expect monthly payments. The payments are the same amount each time. An example would be a mortgage, notes payable, or you're paying off a house if it's got a fixed rate of interest. Each payment includes principal and interest. As we start, the payments in the beginning include a lot more interest expense than the payments toward the end, because as time passes, the unpaid balance of the loan goes down, which is what the interest expense is based on, and we'll see this in our example. Business loans for cash may be much shorter term, like 3 to 5 years, where a mortgage could be 25 to 30 years. Once your last payment is made, the loan is fully repaid. Now, most of these loans have monthly payments, but to shorten our problem, we're going to do yearly payments. So here is our example. It's going to be a 5-year loan. $20,000 total principal. Using the mathematical principle present value, which present value of ordinary annuity type calculations, with 5.9% interest, 5 payments, $20,000, you'd be paying $4,735, and it was like $47.35 and 2 cents. So we're just simply rounding off. We're not going to show any cents, just to keep it a little bit easier to deal with. So borrowing the money is no different than other types of loans. We're going to sign a formal debt instrument, and we will just deal with principal to begin with. So we'll pick up the $20,000, and as no surprise, we would expect our assets to go up because of cash. Notes payable certainly is a liability. That's going to go up. It's going to be a long-term liability. No change to stockholders' equity or net income until we have some interest expense. And we do see a cash inflow, and it's a way of raising money or financing the business. So we have F for financing. And we will set up our loan in our ledger, general ledger, and we'll track just the note and the interest expense. Okay. First payment comes, and again, we're sort of doing this the longer way. We'll look at an amortization table later, but I think let's go through this, doing the calculation for each of our entries. So the only thing we know for sure is our cash payment. I'll drop down a few lines. Every time will be the same, so $47.35. Each payment will include interest. And if we adjust the books once a year, because we're doing statements once a year, then we don't really have to accrue interest. And normally, since this is a monthly payment, you definitely wouldn't have to accrue interest. More than likely, unless I guess if you pay at the beginning of the year, you would accrue toward the end. Beginning of the month, you'd accrue at the end of the month. But for our purposes, we're going to pay at the last day of the year, so we won't have to deal with adjusting entries. So every payment is partly interest expense, and then the principal translates to the notes payable. So you're going to reduce the notes payable and recognize interest expense. So the question is, how the heck do we figure that out? It goes back to the basics that we've done before. Principal times interest rate, which interest rate is usually annual, times time. So our first payment will have principal of $20,000, interest rate, we're using 0.059, 5.9%, and the time, since we're making yearly payments, will be 12 over 12. Normally, you'd have 1 over 12. So that's something to keep in mind, but usually your payments are monthly. So if we simply calculate that, and I won't do 12 over 12, 1,180 represents the cost. That's your interest expense. So the notes payable, if you know 2 of the 3 numbers, then we should be able to figure out the other. So the total amount you pay less the cost of borrowing for this period leaves you with an amount that can go against the principal. So 3,555 will be the reduction to principal. I'll post that up here, and we'll figure out what the ending balance is. 20,000 minus 3,555, 16,445. Let's see if we can bold that. Okay, so that's the ending balance for the first year, hopefully, if the math is okay. So then we go on, and really the main thing we're seeing is these payments until finally the last payment's made, and hopefully the note is zero. So we can do the same account titles. Let's see if I can do this. Just bring it down. And the payment amount is the same. Oh, I'll come back in a minute. Let's see. But every month we're going to see that our amount of interest will change, and therefore the principal will change. Let's come back up here and finish the impact on the statements. Your cash is going to go down, so that's your assets. And your, let's see, notes payable is going to also go down. So we'll reduce that by 3,555. And then interest expense is retained earnings, so stockholders' equity will go down by 1,180. And hopefully if you add 3,555, just to prove it to ourselves, to 1,180, the stockholders' equity liability side is then equal to the asset side, which it should always happen, that you balance your balance sheet. So it did have a pretty major impact. And then of course your profits will be down because of your expense, and you'll have a cash outflow. Now this one's going to be a little bit of a challenge because your cash payment is reducing principal and interest. So your principal part will be financing, and that's going to be, let me go back up here. Your financing part is 3,555. Your notes payable will be the financing piece, and then the cash for the interest part will be operating. So we have to separate the payment between the two components. Okay, that was a challenge. Then the next payment is similar, but this time we notice, of course, our principal has come down. So we have 16,445 times the interest rate. And again, if it were monthly, you'd have 1/12. So if we do our calculation, new principal, same interest rate, and I'm going to round it or drop it in this case to 970. So that's going to be our interest expense. If we know our interest expense, again, the payment less the interest, the cost of borrowing, is the amount that we can use to repay, $37.65. Notice that we do pay less interest on the second payment. Every time we make a payment, there should be less interest because our unpaid balance is coming down. So here, I'm going to take that out. And we reduce the note by $37.65. I haven't been running the interest up, but each time you record it and then it's closed into retained earnings. Second year, 970. End of the year, it's closed. So there's no balance that carries over. So what is our principal amount now? $20,000 less the first year, less the second year. Looks like 12,680. So 12,680 times 0.059. Whoops. And we'll do our math. So you can see there's a pattern here. We kind of see the same thing each time. I just lost my calculator. Okay, 12,680. Yeah, it's not going to behave. Oh, I know. Numbers lock came off. 12,680 times 0.059. And again, 12 over 12. So that's 748. Okay, so 748. I guess I should have brought this down. At least the titles don't change. Could always be worse. So 748 is the interest expense for the third year. Cash as usual is given. And of course the reduction to principal should just simply be the difference. So if we take 4735 minus 748, 3987. 3987. 3987. Make sure I don't do any transpositions. I'm not going to show the impact because really all the numbers change, but it's the same impact each time. So now our loan has managed to drop again by, you notice the principal reduction is increasing each time. So our unpaid balance at this point is $20,000 less the first year, less the second year, less the third year. Yes, I'm doing it the long way, but anyway. 8693. Did I do that right? Okay, 8693. Let's hope. Oh. No, that can't be the ending. Yeah, it could be. Because we've got that 9,000. That doesn't sound right, does it? If we take those numbers, look, let me try this again. I think I probably made a mistake. So we have 20,000. Do it a little slower, right? 3,555 minus 3,765 minus 3,987. 8693. Okay. 8693. Okay, so over here, 8693 times 0.059 times the usual time. 12 over 12. Okay. So if we bring down, this is the fourth payment now that we're making. And we always can fill in our cash payment. And we're trying, I think, to figure out the interest expense. So if we do the calculator, 8693 times 0.059, 512. I'm going to round it to 513. That's pretty close. So the interest expense is 513. And then once again, we're going to solve for the missing number. Much lower interest expense, finally. And it mathematically is designed to work out, of course, that it's fully paid at the end. So the cash payment less the interest, 4,222. Whoops. Okay, so that's going to reduce the note further. And this time, maybe if I'm smart, I'll just take the ending balance from last time, 8693. I have to go through all those steps and subtract out just this year, 4,222. So that's 4,471. Okay. 4,471 is the new ending balance. And so in the last payment, 4,471 times 0.059 times 12 over hopefully this is the last payment that we make. Okay, so same payment, the smallest amount of interest that we're going to have. So let's throw that in there. And that's 263. Let's round it to 264. So that's interest expense, 264. And then we'll solve for, again, the missing number. So 4735, take away 264, 4471. Let's hope. Okay, and we do have a balance of 4471, so I think we're good. If we're to be $1 or so off, it'd be due to rounding, and that's fine too. So now we have a 0 ending balance, interest that I didn't keep up with, but that has been there. Every year you've recorded interest and then you've closed the books and it's closed out. Every year the interest expense has gotten smaller. 3 until it reaches 264 in the last year. So as far as the income statements go, you would have had a smaller and smaller interest expense, which would give you more profit. Your notes payable, as we can see, would have come down on the balance sheet each year until you finally have paid it off. Now, after all that work, we'll show you something that, if you do it first, actually would make your entries easier. Each payment, we put year, but each payment would be on a separate line. This works out well with Excel or spreadsheet type thing. You start with your principal balance. You show your cash payment, which of course for these kinds of loans will be the same each year for your payments. So, yeah, I'm not sure why the last is blue, but anyway. The interest expense, we've done the math already, which you probably can't see, but the interest expense that we calculated, I guess the first one was 1180. So you would use principal times interest times time and figure that out, and then the principal repayment would be the cash payment minus the interest, or in fact we could actually number these columns and say it that way. Let's put in, and different amortization tables can have a slightly different format, so we're kind of repeating beginning principal and ending. But you start with your original loan, you put in the payment that again is the same amount each time. The interest expense is calculated by taking principal beginning, interest rate annual, time 12 over 12. Then the principal repayment is column 2 minus column 3, or cash payment minus the interest expense. We've already done that, so we won't do the math there again, but 3,555 was the result. 3,555. And then the ending principal will be the beginning principal balance, or column 1, minus column 5, which is a repayment. And we figured that out. This would have been 16,445. So in this particular format, the ending principal balance for year 1, or the first payment, becomes principal balance for the next period. And then you do similar things. The interest expense for year 2 is the new principal balance, which we now see here, 16,445, and then you multiply that times the interest rate that doesn't change, 5.9% or 0.059 times 12 over 12. When we do this, we had 970 here. So let's fill in the 970, and then column 5 is simply column 2 minus column 3, or cash payment minus interest. When we did that, we had 3,765. I think it's good to be able to do the journal entries without the table, just to make sure you understand it. And then your principal repayment, once again, is the beginning principal balance minus the principal repayment equals the ending principal balance. And so the ending balance was up here, which we figured 12,680. So 12,680. And then ending, that becomes the beginning. Okay, and then the usual, we figure out the interest on 12,680. So we had it up here, 12,680 times 0.059, and that would have been this one, $748. So, whoops, I don't know what that did. 748 is here, and then we take the cash payment minus the interest expense equals the principal amount, which we figured out to be 3987. 3987. And then column 1 minus column 5 equals column 6. So what's the remaining principal balance? We figured out is 8693. And that we end one period, we begin the next with the same thing. And you can see the pattern. 8693 times 0.059 to figure out the interest, which is this calculation. And that was the 513. And then your cash payment less the interest equals your principal repayment in year 4, which was 4222. And then the ending balance would be 8693 principal beginning minus repayment of 4222 equals the ending, which is 4471. So we end with that, we begin the next year with that. Guess we'll just have to do blue. And the interest in the very last year, 4471 times 0.059 is the smallest amount, $264. So if we put 264 in there, the payment less the interest equals the reduction to principal, which is 4471. And we've seen that number before. So the beginning balance minus that equals 0. Jackpot. And that's what we expect to see. If it's off by $1 or $2, it's probably simply rounding. So if we had developed this first, we would still have had to have done these calculations. But we would have had the table in front of us, and you can see it does expedite things because you've got, column 2, 3, and 4 is exactly what you need to do your journal entry. The cash credit, the interest expense debit, and the notes payable debit. So that concludes our clip on installment loans.